Welcome to this month's Bob Benny Wealth Management webinar. Today our topic is how to handle market volatility. And I'm Bob Benny. And
I'm Jessie Thompson.
And Jessie, why don't you tell them how to ask questions during the webinar?
There's a box at the bottom of your screen that you can click. It looks like a text box. You can click that, type your questions in. You can type in your name or remain anonymous. We won't say your name when we answer these, and we'll answer everything at the end of the webinar.
So let's start out with a brief review of the market so far this year, Jessie.
So the market has been pretty volatile for the beginning of 2022, and kind of a market rule of thumb is that when there's uncertainty in the world or in the news, there's going to be volatility in the stock market, and we've definitely seen that so far for the first few months this year. And the reasoning behind that has mainly been based around fears about the Fed raising interest rates, and that was mostly what was going on with the market in January, and that was kind of the main part of the news in January. And then towards the end of January and February, we started to see things heat up between Russia and Ukraine in that conflict. And so between those two things, there was a lot of uncertainty in the market.
Not just the things heat up, but the news coverage of it.
Yes.
24/7 news coverage that Russia's going to invade Ukraine. Scary, scary, scary for weeks before it happened.
So year to date, what the stock markets have done, the S&P 500 is down 8.5%. The Dow Jones Industrial Average is down 6.27%, and the Nasdaq is down 14.16%. And do you want to go over a little bit about what each of those are?
Well, the S&P 500, Jessie, is the 500 largest stocks on the New York Stock Exchange, and that's probably the best measure of, quote, the stock market. The Dow, which everybody's familiar with, is just made up of 30 stocks, and they made out the Dow Jones Industrial Average in the 30s, long before they had computers, and so they even calculators to add up so they only made it up of 30 stocks. So one movement up or down, of significant movement up or down of one of those 30 stocks can kind of skew that average. It generally tracks with the S&P 500, but a better measure is the S&P 500. And then the Nasdaq Index is a different market. It's made up more of growth companies, younger companies, and technology-oriented companies are on the Nasdaq.
So we're going to talk a little bit about both the situations that we discussed earlier as far as the Fed raising interest rates, which we found out about yesterday, and the Russia-Ukraine situation, how that could affect your investments and what you should do about it. So we're going to start off with the Fed raising interest rates.
And this was expected that they were going to have their meeting Wednesday, and it was pretty much expected that they were going to increase interest rates. And they announced that the interest rate increase in the Fed funds rate, which was at 0%, now went up by 1/4%. And interestingly, even the market anticipated this. Well, they anticipated it, but on Tuesday, the S&P, before they ever met, the S&P 500 went up 2.2%, and on Wednesday, yesterday, it went up 2.2% as well. So 4.4% in 2 days for the S&P 500, the large 500 largest stocks on the New York Stock Exchange Index. And then the Nasdaq, which is more volatile. Volatility means up and down. We never worry about upwards volatility, but people don't like the downwards volatility. But the Nasdaq on Tuesday went up almost 3%, 2.9%. And on Wednesday, it went up almost 4%, 3.8%. So in spite of this devastating increase in interest rates, how the news media was telling everybody that was going to crash the stock market went up substantially in the last 2 days because of that. And it went up, it's up today, not as much so far, but it's both, all three markets, the Dow and the S&P and the Nasdaq, the ones we mentioned, are up again today. It's the thing I want to remind people, and I've talked to some of our clients, and and in some of our webinars, talk to our team here at Bob Benny Wealth Management daily, is that the news media was attempting to scare people in December and January about Fed going to increase interest rates to fight inflation and how that was going to crash the stock market. Well, that's just a big fat lie. Historically, these interest rate increases by the Fed don't crash the stock market. But once you tell enough people the same thing over and over again, some start believing it. That caused some sell-off. That happened until about the third week in January, and then the people started figuring out that the media didn't know what they were talking about, and the market started coming back up. That was prior to then all the big fear of the war with Russia invading Ukraine.
And historically, we have a graph to show you guys that shows kind of historically what the market has done during interest rate hike cycles like we're going to be in here. And so this shows the performance of the S&P 500 during interest rate hike periods. And these returns here in orange are annualized. So some of these periods are for more than 1 year. So this is the average annual return of the S&P 500 over those years. And so the average during all of those rate increase periods, the average return of the S&P 500 is 9.4% annually, which is pretty good. So it doesn't drop the stock market or crash the stock market or hurt the stock market historically.
So logically, though, what I've been talking about and telling some clients that I've met or called about, if you think about it, interest is a cost. Obviously, it's a cost to companies. And so if interest rates go up, and that's a significant portion of their costs, that's going to have an effect. However, most of the companies that our clients investing in the stock market, they don't borrow any money at all. And when they do borrow a significant amount of money, they issue bonds, and bonds have a fixed interest rate. And so the companies that already have bonds, corporate bonds out right now, they're already set on a fixed interest rate. An increase of 0.25%, or even if they increase it 0.5% 5 times this year, that's going from 0 to 2.5%. That's not going to have a significant impact on corporate earnings. And remember, the key value of a company is based on its earnings and its projections of future earnings. And those current earnings are very strong. And the projection of future earnings are very strong. And so there's no rational reason for the stock market to have gone down the way that it has over the last 2-3 months. And so it's a fear-driven kind of panic, somewhat of a sell-off that's caused the market to go down. And it's nothing for us to worry about because it's going to come back up.
So the second thing that's been impacting the markets in the last couple months is the Russia-Ukraine conflict. And when the day that Russia invaded Ukraine, which was it February 23rd?
Yeah,
I think so. We saw the market drop significantly right when that news broke, when that happened. But by the end of the day, the market had gone back up and more than recovered.
Way more than recovered. It actually had a really big day.
By the end of the day. And that's kind of a reflection of what we've seen historically with situations, geopolitical situations kind of like this, with invasions or kind of geopolitical crises, where there's initially a bump in the market due to a downwards bump, due to the uncertainty and fear that people have about what the situation is going to be like, what the results are going to be, how far reaching they're going to be across the world, things like that. But once that fear kind of wears off, the market starts trending back up. And so we have a couple of slides or graphs to show you that kind of show that. So here's the first one. This is a number of geopolitical market shock events, situations that have happened throughout history. And on average, we can see that the market recovers from these type of events, and this does not include COVID.
actually. But we see that the market recovers from these types of events on average in about a month and a half. And the two biggest events that took the longest for us to recover from, this is for the S&P 500, is the Pearl Harbor attack and Iraq's invasion of Kuwait. And if you took those two huge events, especially the Pearl Harbor attack in World War II, out of the situation, it'd be even less.
Yeah, those are the only two events that took over 100 days to recover. If you look on that in that column over there on the right.
And so I have one other graph to show you guys, and this graph is about how the markets have reacted to invasions of war. And so, as you can see, we've got Vietnam, the Gulf War, the Afghanistan War, the Iraq War, and the Crimean Crisis. And leading up to the invasions, or leading up to the actual breakout of the war, you can see that the market gets very volatile and usually drops right when that news happens. But then the market recovers, kind of like what we're seeing right now, and goes back to normal. So the market reacts more to the uncertainty of war than war itself historically. Right.
And then the other, we kind of skipped over because our table didn't show what happened with the, when COVID broke out in February and March of 2020. So let's we have a graph for you of that. And this is a chart of the S&P 500 from 2013 until present. And you can see over in the shaded area on the right in 2020, show with the pointer there, honey, and that the big market dropped because of COVID. And, it was in a month and a half, the stock market went down, or ballpark a month and a half, the stock market went down 30% or 35%, depending on which index you're looking at. And as this was happening, we had some clients that were talking to me about it and maybe worried about it. Not a whole lot of clients because it happened so fast, but I told them it doesn't make any rational sense. There's no reason that this virus should cause the value of companies, because that's what stock prices are. It's the values of companies. No reason for that to cause the value of companies to go down by 30%, let alone even 5 or 10%. And so we kept our clients, our managed accounts, we kept invested. We urged all of our clients not to get out of the market. And we ended up experiencing then in the next 2 or 3 months, as you can see, the market recovered and went on up from there. And so that's a typical or a similar situation that we're in right now, both with the talk about the Fed interest rate increases, and not just this one yesterday, but the ones that are going to happen this year and beyond, but also the Russian invasion of Ukraine. So
one other thing that I wanted to show really quickly is a graph of the VIX. And this is a different kind of index. So what the VIX is, this is a Chicago Board of Options index that measures the volatility in the equity market. Basically how many people are buying options.
Yeah.
And so
the peaks are when there's a lot of volatility on this graph.
Yeah, so it's kind of not necessarily directly the opposite of what you would look at in a graph of like the S&P 500 or the Dow Jones Industrial Average, but kind of where the peaks are negative things. So the peaks are super high volatility times. So as we can see, the highest volatility times that we've experienced in the past, 20 years or more now, would be 9/11, the global financial crisis of 2008, 2009. And this was also the longest high volatility time that we've experienced in recent years. And then the COVID-19 pandemic was really high, but that was a short volatility time. And then right now is where we are right here with Russia invading Ukraine. And as you can see, that's a lot lower volatility than what a lot of people on this call, as if you've been investing for any amount of time, it's a lot less than what a lot of people have handled before and experienced before. So we're not in anything
new.
Right, and even the COVID thing that happened just 2 years ago, the volatility is about half of what it was for that. Now, interestingly, everybody's also experienced the price of gasoline going up.
Yes, and I think that's what worries people about the stock market. A large worry is because the price of gasoline and how that could affect the stock market and the economy as a whole.
Well, the thing that I find very interesting is that the United States only gets 2% of our total oil, crude oil, from Russia.
You wouldn't know that.
You wouldn't know that.
You wouldn't know that hearing from the news. Yeah.
No. And so just as just as fear and panic or whatever has caused the stock market to go down, the same news about that there's Russian oil involved has caused the price of crude oil to go up because there's a market for that. And that's gone up and then it's pulled back significantly from where it was. Hasn't caused the price of gas to go back down yet, but it went up and then it's come back down some. And it's again because of news media driven fear and panic that has all happened. I find it pretty kind of hilarious that President Biden banned the U.S. purchase of Russian oil, the 2% of what we use a week or two ago, because Russia's still there's a global market for oil. Russia's still going to sell their oil. They're just going to sell it to somebody else, and we're going to buy ours from somebody else. So it isn't going to have any effect on anything, and it isn't going to hurt Russia. And that's not anything to worry about. I think that gasoline prices will subside some. We significantly subside. The big impact on our gasoline prices was, frankly, the Biden administration and shutting down domestic production and the pipeline and that sort of thing. Before he was elected in the fall, before the election, we were buying gas at Costco for under $2 a gallon. And it didn't take very long for that to get up above $3 a gallon. And so of that 50% increase, the big increase of recently in the last year or so of gas prices has been because of our own federal government.
So when we're in seasons of, I guess, market volatility, or when we're experiencing market downturns like we have in the last couple months here, I think it makes a lot of people feel uneasy. Nobody likes to see their account go down. It makes people uncomfortable. But how can people who are patient, wise investors take advantage of times like this?
Well, absolutely. The number one thing that we all need to do is don't panic. When the news media is trying, and the politicians, particularly the leftist politicians, are trying to scare you, don't panic, relax. And that's the number one advice I can give anybody, or how to take advantage. And then you start thinking about things. And so because this is an irrational market downturn, irrational meaning that the earnings are there, the companies are doing well, the economy is doing well, and just panic has caused the stock market to go down, this is a buying opportunity for people. This is, things are on sale. The prices are going to go back up and you're going to make more money in the stock market now buying. So if you have money on the sideline, sitting in the bank that is going to just lose its buying power because of this high inflation we're experiencing, you need to get an investor to take advantage of the market downturn to get in when stocks are on sale. This is also a great potential time to convert traditional IRA money to Roth. You can do that when you convert money to Roth, to the tax-free Roth IRA. You got to pay taxes on the amount that you convert. So if your IRA, if you had whatever, an account this big before the market downturn, after the market downturn, it's down here. If you could, whatever you convert is what you got to pay the taxes on. And the taxes now, if you do a conversion today, you don't have to pay the taxes aren't due until April 15th of next year. So we had a number of people do that 2 years ago with the COVID panic, and the market dropped 30% or more, and took advantage of that. And within, a few months, their account was back up. They paid the taxes on the smaller amount and made out like bandits. And remember the best and worst investments in periods of high inflation. I've talked to people about this on the webinars. I've talked to people in person a lot. But we need to keep that in mind. The worst places to have money in periods of high inflation is to have it in cash, which is essentially also actual cash, but savings or checking accounts, which is just like cash because it doesn't make hardly any interest, CDs or bonds, because all three of those things, you're going to lose buying power. For instance, you have $100,000 in the bank today, you can buy $100,000 worth of stuff with it, goods and services. If we have 10% inflation, and I think it's going to be worse than that this year, you're only going to be able to buy $90,000 worth of stuff with that $100,000 a year from now, and it's just going to get worse. So don't have money in cash, CDs, or bonds. Where you should have money is in assets like companies. I think companies are the best hedge against inflation, because if you think about the definition of inflation being the rising cost of goods and services, rising prices, companies are who produce and sell the goods and services whose prices are going up, and they will go, their values will go up too. The second is real estate, particularly income producing real estate. And the third is gold. And I don't like gold as much as real estate or companies because it doesn't produce anything or rent anything out or anything like that. But that's another hedge. Ultimately, we all have a choice. The choice is either hoard cash in the bank and be fearful and lose buying power, because you are going to lose buying power if you don't have your money working for you, or deal with the volatility, tolerate the volatility of the stock market.
So we're going to talk a little bit about our advice for how to tolerate the volatility of the stock market, because we know it's not easy. It's difficult to watch your account go down during volatile times, during market downturns. It's difficult to look at your statement, or whether you get your statements paper, or whether you're looking at it online. That's not fun. Nobody likes that or enjoys it. But we think it's really important to remember that market downturns historically have always been temporary, and that they're a normal part of investing, of long-term investing. And I think a lot of people feel the need to do something when they see their account go down, or take action, or move things around so that it won't go down anymore, or something like that. But usually the wisest thing that you can do is make sure that you're invested properly in positions that are long-term, fundamentally strong investments, and then just stay put and ride out the ups and downs of the stock market.
Right. The people that make investment decisions based on fear, on emotion, and the two emotions that often affect people's investment decisions, or sometimes do, are fear or greed. And those are where you make mistakes. Fear causes people to sell when they should be buying, and greed causes people to buy when they should be selling. And so it's kind of the opposite. And my job, our job, is to help people manage those emotions, help explain, what we know about the effects of interest rate increases or wars, and what we know about the health of the stock market. Because the stock market, the companies on the stock market, American companies, are very healthy right now. And this is a time to be buying or holding, not a time to be selling. So, the companies are making money. I was talking about that a little bit. And in 2021, you wouldn't know this listening to the mainstream news media or the financial news media, but in in 2021, several large companies that have been around for a very long time had all-time record profits. In addition to that, after we got through 2021, these companies start reporting their quarterly and their 2021 earnings, and there's these analysts on Wall Street, these accountant types, that there's thousands of them that analyze the books of all the companies on the stock market, and they project their future earnings and things like that. And 75 to 80% of the companies that have reported their profits for 2021 and the last quarter of 2021 outperformed what the analysts' expectations were. Outperformed them. And the analysts' expectations were not, they were bullish. They were generally that companies were going to make money, but 75 to 80% of them did better than the analysts even expected. So that's a good sign, and that's why people need to stay invested. Remember, the news media sells, they're selling you. They're selling you fear. They sell fear. They've been selling fear to us for years, particularly in the last couple of years. Fear about racism, fear about COVID, fear about interest rates going up recently, and fear about this war going on between Russia and Ukraine. And the more they can get people stirred up, the more people keep watching. Politicians, particularly leftist politicians, also take advantage of these created crises or make a bigger deal out of something and turn it into a crisis than it is. And for instance, what we saw happen last week was that the politicians, the leftist politicians, got passed in kind of a last-minute budget record or budget bill, $14 billion for the war in Ukraine. That's a lot of money for a little country on the other side of the world that, had there been more time, because the truth always comes out with time. Had there been more time, that probably wouldn't have gotten passed. Fortunately, they also had $22 billion in that bill for COVID, and that got knocked out. Fortunately, they couldn't get it to pass, and so they're not spending another $22 billion on COVID, but they did budget for $14 billion for the war in Ukraine, and that's unfortunate. So I guess I want to ask all of our viewers or whatever, based on the recent track records, should you trust the media and these leftist politicians? And if you've been paying attention to what they've been saying and what happens when the truth comes out, you know that you shouldn't trust them. So you shouldn't trust them anymore. When the news media and the politicians are saying the same thing, there's something going on. And so we all need to keep an eye on that and not get sucked into this 24/7 news cycle. Well, I'm not just talking about the mainstream media, but I'm talking about social media and all this stuff. We need to live our lives, and we all need to manage our emotions by limiting the amount of news we take in. Used to be, decades ago, people read the newspaper in the morning or in the evening and watched a little bit of news, and that was it. Now, if you don't manage it, it just is constant, and it gets people nervous and scared. We also need to use discernment to identify the trusted news sources. And I can tell you the mainstream media, ABC, NBC, CBS, CNN, and MSNBC, you can't trust at all. And maybe you can trust Fox News a little bit, but they get roped into some of these stories too and like to talk about COVID all the time or Ukraine all the time too. The final, I guess, encouragement or advice I'd like to give our viewers is focus on what's important to you. Focus on really means a lot in your life, like your family and your friends. And work on your health. Particularly, I've been really focused on in the last couple of years, my physical health, my mental health, and my spiritual health. And I've been doing great. I've had a great last couple of years. I'm the healthiest I think I've ever been in my life. And because I'm not letting the news cause me to panic. It's important for our business, Jessie, that we remain calm and not panic and look for the truth so that we can give our clients good financial advice.
That pretty much wraps things up for today. If anybody has any questions, they can type them in now. I don't see any that have come up so far.
But if anybody does, you know, just you can send us an email to Jessie@bobbenny.com or Bob@bobbenny.com, or you can just call the office at 421-2626. And we'd love to get feedback from you if on things we're doing right or things you'd like to see us do different, or something we did wrong or whatever. And we just want these to be helpful to you, and we hope you all have a blessed day.
Thank you very much.